In this video, we are going to talk about impairment of assets, IAS 36. And if you will open your IFRS standards book at IAS 36, you will see that it will explain the purpose of the standard, the scope, definitions will be given, how to identify that a company's asset is impaired, how to measure the recoverable amount. So that will be our fair value less cost to sell, or how to calculate your value in use. Then how to recognize and when to recognize, and how to measure your impairment loss. It will explain how to treat cash generated units and goodwill, how to account for an impairment loss for a cash generated unit, the reversal of an impairment loss, and then the disclosure and when is the effective date. So if we look at the scope specifically, impairment of assets will apply to all assets except inventories, and you can work through this list, but what this means is IAS 36 is not applicable on inventories. We've covered that last year. Financial assets will cover later this year. What about our non-current assets classified as held for sale? We will also cover this year. Deferred tax assets we've already covered. So just please take note of this. These standards, they will follow their own measurement requirements, and IAS 36 will not apply to them. So recognition. So when will we have to recognize an impairment? So you have to test if there's an indicator. There's 3 exceptions where we have to test an asset for impairment every year, even though there is not an indicator of impairment present. And that will be intangible assets with an infinite useful life. So, and then an intangible asset not ready for use. So these 2 assets will not be amortized. So therefore they might be overstated. So we will have to test for impairment every year. Then goodwill. Goodwill, we always test for impairment every year. So even if there's not an indicator. So what is an indicator? And this you can also flag in your standard. But it can be internal indicators or external indicators. So internally, so within the company, is there any signs that tell us that our asset is overstated? And this can be, for example, physical damage to the asset. External sources or indicators will be where something in the economy happened, or in the country, or anything happened outside the company, and that will cause our asset to be overstated. How is an individual asset tested for impairment? So we will compare its carrying amount in our books with its recoverable amount. And recoverable amount, you will remember from last year, will be the higher of fair value less cost to sell or value in use. So we will assume the company will use the asset in the way that they can get the most out of the asset. So if it's better for them to sell, then we'll use the fair value less cost to sell. Or if they will get more out of the asset by using the asset, we will use the value in use. So how will we determine the fair value less cost to sell? Fair value is your selling price in a binding arrangement. If the above is not available, use your market price. If the above is not available, then the outcome of recent transactions for similar assets. So most of the time in a test, we will tell you what is the fair value of the asset. And cost of disposal that you will deduct from that fair value will be legal costs, transfer costs, cost of removal. Just very important to note that this cost to sell, it must occur because you are selling the asset. So we would have not incurred the legal cost if we did not sell the asset. So therefore, that will be included in my cost of disposal. In the next video, we will discuss how to calculate our value in use.